Okay, so um, welcome, guys. Today's topic, I'll be talking about reasons why the market moves. There's four reasons, but before I do that, I feel like I missed a few points from my last video regarding New York kill zones. These times are very important to note, guys. Just to cover this, very important to note. Make sure you write this down, okay? The New York kill zone is the highest volume traded during the day. Okay, so New York, the New York session opens at 5 a.m., but we trade 5 a.m. to 6 a.m. and 7 a.m. to 10 a.m. Okay, that's what we trade. That's what I recommend. Other ICT traders trade differently, but that's what I recommend, especially if you're just starting out, because between 6 a.m. to 7 a.m., right? We don't trade that because of stock market open. There's a lot of volume, a lot of volatility, there's a lot of news, right? Remember, we're trading indices, we're trading NASDAQ, we're trading ES, but with a high emphasis on NASDAQ. And NASDAQ is the world top 100 stocks and the tech stocks in the world. So you can imagine the volatility when the stock market opens and people are all over the world are buying stocks, right? So doesn't matter what strategy you use, right? You're gonna get smoked. You're gonna get cooked. But if you're like some crazy scalper, you like the volatility, you'll probably thrive in that market, right? But that's not our style. We can be scalpers, but we're more like, I would say, intraday type of traders. It depends on how fast our trade go. Sometimes our trade could be quick scalps. Quick scalps meaning trades lasting like seconds, right? But most of our trades last like 5 to 10 minutes. So we're more on the intraday type of trading kind of side. Because sometimes some of my trades last like an hour. Depends on how fast the market moves. Depends on my target as well. It really depends on our targets. So I've had big targets where one of my trades lasted 2 to 3 hours. So that's intraday trading. Okay. Scalpers, what they do is they hunt small points in the market, very small points. Like for example, in NASDAQ, like they would target 2 points. Like for us, we're intradays, we would target like 50 points, 30 points, right? And they traded really high leverage, so it's very risky, very risky. I wouldn't recommend scalping if you're a beginner. I would stick to a trading plan, safer intraday trading plan. Okay. So anyways, back to the kill zones. Kind of lost track there. So New York, 5 a.m. to 6 a.m., 7 a.m. to 10 a.m. PST. London session, 11 p.m. PST to 2 a.m. PST. Asia kill zone or Tokyo, 5 p.m. PST to 8 p.m. PST. You want to focus at this time. If you trade outside of this time, there's no volume. There's not enough push in the market. Your trade is going to go sideways and you're highly likely to lose your trades. Okay, there's not enough push, there's not enough volume. Okay, make sure you write this down, very important. Okay, I'm going to delete this now. Now we're going to focus on this. Okay, these four reasons why the market moves. Okay, let me increase the size. I know previously you guys heard me say there's only 3 reasons, but there's actually 4 or 5. But we're just gonna focus on the most important ones, okay? Because our strategy focuses on these important ones. Okay, 4 reasons why market moves. You got 1, hunt liquidity, sell side liquidity, buy side liquidity, internal liquidity, fill imbalances, fair value gaps. They're the same, imbalances, fair value gaps. Sometimes you might hear the word inefficiencies. They're all the same, fair value gap, imbalances, and inefficiencies. Okay, generate liquidity. Though it's not important for our strategy, I think it's kind of important to keep at the back of your head to know. And news, okay, news, and we're gonna go over each one. Okay, we're gonna go over each one, so you guys have an idea with what the market does. Okay, all right. So number 1, hunt liquidity. Number 1 reason why market moves: hunt liquidity. So what is liquidity? Liquidity is basically just money. And how does market get money? How does the market take money from you? They hunt your stop losses. That's liquidity, your stop losses. Okay, when you're buying in the market or when you're selling in the market doesn't take your money yet, because it's still yours, right? You haven't closed your trade yet. But as soon as the market hits your stop loss, right? As soon as the market hits your stop loss, the market takes your money. Okay, that's what I mean by hunting liquidity. That's the reason why markets move. They like to hunt these points. This is external liquidity, this is internal liquidity over here, and this is external liquidity, sell side, buy side. We'll go over that. I'm going to go over liquidity in depth, but just so you guys have an idea, they like to hunt stop losses. Okay, just remember that. Number 2, fill imbalances, fair value gaps. So as you know, I'm going to go over fair value gaps in depth as well. But fair value gaps are imbalances in the market when big buyers and sellers enter, and then you get these big movements in the market. These big movements in the market, okay, and that causes imbalance that the market tends to go back to be filled. Okay, we don't know when they're going to be filled, but they eventually get filled. Okay, that's just what the market does, right? They like to go back to equilibrium. They like to fill everything as they go. That's the nature of the market. Why? I don't know why, but that's what pros do, right? That's what pros use, and this concept is one of the most important concepts, fill imbalances, and a lot of traders use that concept. Okay, why does the market like to fill imbalances? I have no idea. Probably equilibrium, but just know that markets like to fill imbalances. They like to fill fair value gaps. They like to tap into that. What do I mean by tapping into it? I don't know how much knowledge you guys have in the market, but these candlestick patterns, right? Markets like to tap into it, meaning they like to wick over it and then reverse. They like to wick over it and reverse, right? They tend to like, it tends to be like zones where price tend to bounce off from, right? These imbalances. For example, like here, imbalances here. If you watch closely, there's a fair value gap here, right? Markets like to bounce off that. You see that? Markets like to bounce off fair value gaps. So they're like basically magnets. Okay, they're magnets. That's all you gotta know for now. We'll go deeper into fair value gaps, but they like to hunt liquidity, fill fair value gaps, and generate liquidity. It's not important, but I'll tell you guys anyways about it. So what does it mean when the market generates liquidity? Here, I'll show you. When markets generate liquidity, they're basically just consolidating. They're basically just consolidating. And where is that? One sec, here. So when the market's just consolidating, they're doing this, right? They're doing that. That is consolidation, or that is called generating liquidity. Why is that generating liquidity? Because you got all these peaks over here. You got all these peaks, and in those peaks over here, this is where the market, you know, in these peaks, have stop losses. Because you have really dumb traders, including me, that when we first started, we're really stupid, right? We don't know what we're doing, and we think that the market's going to reverse, so we're going to sell here, boom, and then as soon as it points here, so when we sell here, right, when we're inexperienced, we sell here, we put our stop loss here, and we target here, right? So we have stop losses here. We think it's going to go down further, but nope, market consolidates, goes into a range, right? It goes into this range over here. It goes into this range, and you have buyers here that think market's going to break this range, so they think it's going to go up, so they're going to put stop losses here, and it's going to happen over and over again, so to a point where you have stop losses here and stop losses here. So you have all this liquidity, guys, all this liquidity. When markets range like that, that's how retail traders who don't know what they're doing, if they're a beginner, that's how you get smoked. Okay, I repeat, that's how you get smoked. When you see something like this in the market, you stay away. You stay away, guys. Trust me, you stay away. You're gonna get cooked, because eventually what market likes to do, this is called accumulation. Okay, accumulation, generating liquidity, it's all the same. Accumulation, okay, this is markets accumulating over here. Okay, consolidating, accumulation, generating liquidity, it's all the same concept. Just don't get it confused. There's a lot of terms and jargons out there. A lot of them are just exactly the same. Okay, I'm gonna try to keep it simple. So this is called accumulation. Okay, there's a concept, it's called AMD. So what markets like to do after they generate liquidity, okay, they accumulate and then they manipulate. Meaning, you got this random big wick over here. That's called your manipulation leg. They manipulate, okay, and then they go into the range a little bit. When they manipulate like that, they took out all the stop losses here, took out that liquidity. So after this manipulation leg, the market is strong enough to go on a bigger move. And that bigger move, guys, is called distribution. Okay, market's big enough to go on a distribution move. Once it breaks this range, okay, all the stop losses get taken out. Now the market has more money has more money to move. It got more liquidity. Now it's ready to move, to make its real move. Okay, its real move. Once the market, took out all the retail stop losses, it's ready to move, and that's called your distribution, guys. It's good to know, but it's we're not really focused on this, but I would say, yeah, it's really good to know. Our strategy, not really focuses on this, but it's good to know, guys. It's good to know. This is just to repeat, this is your accumulation, this is your manipulation, this is your distribution. Okay, that's your AMD. Really important too. Okay, it's also based on why the market moves, right? It likes to hunt liquidity, and along these peaks over here, it's filling imbalances, and as soon as it manipulates, takes out stop losses, and then fills imbalances between here, takes out more stop losses here. Now it has more money, it ate more food, now it's ready to go to hunt, to fill more imbalances or hunt external or more internal liquidity. Okay, that's what markets like to do. So think of the markets as like Pac-Man, right? They eat, they need money, right? If there's not enough money, right, it's not gonna move, right? Liquidity is what moves the market. Liquidity just means money. But if there's not enough liquidity in the market, guys, the market is not gonna move. Okay, if there's not enough volume, if there's not enough traders, the market is not gonna move. So what is it gonna do? It's gonna accumulate over here, right? Once it's accumulated enough stop losses, it's going to manipulate, take out that stop losses, or we call it liquidity sweep. It's making sense now, huh? We call that liquidity sweep. Okay, we also call that liquidity sweep. So it's taking that out. That's your manipulation leg, taking out all that liquidity, right? Filling out all these fair value gaps in here, takes this liquidity. We also call it sometimes, changing the state of delivery, or, in this area, sometimes, I would say most of the time, we that's where we get our trend reversal, right? That's where we get our change of the state of delivery. That's where we get our market structure shifts, or change of character, where you guys want to call it. That's where we get our trend reversals in this area. After we've done our accumulation, manipulation, we manipulate, we distribute. That is our real move. Okay, guys, that is our real move. So, don't get too focused on that, but it is good to know, guys. It is good to know. It is good to know. Okay, so I'm gonna call this the AMD. It is called AMD. Okay. accumulation, manipulation, distribution. Okay, you can go on YouTube. You know, if I didn't explain it enough, if you feel like you're missing some information, go on YouTube and get some clarification. But hopefully I dumbed it down to you guys. There's a lot of trading jargon out there that you don't really need to know. Okay, that's our AMD. It ties into why markets move. Okay, I hope that kind of makes sense. And then news, guys, news. Big movers. So going ahead and type in Forex Factory. Save this website as your favorites. Okay, forexfactory.com. I'm gonna make sure we're recording. Okay, we're good. forexfactory.com. Okay, news. You go to this section. Okay, this section over here. Forget about everything else. Focus on the red folders, USD. Okay, let me repeat that. Don't worry about anything else. Just worry about the red folders and the USD and the time it's gonna happen. Like today, it happened at 7 a.m. Happened at 7 a.m. Okay. Red folder means high impact news. They're market movers. Okay. High impact news. They're market movers. Doesn't matter what market, stock market, Forex, gold, silver, doesn't matter. Every single market is gonna move, including crypto. Okay. Because all markets in the world revolve around USD, right? Every single market in the world, whether it's the stock market, futures, Forex, a lot of it, right, revolves around the United States. So anything red folder United States, guys, be really, really careful. And I suggest you do not trade, okay? Don't trade. At least like wait an hour, wait for the market to cool down. Because it doesn't matter what your strategy is. Depending on the results of this, it's gonna move whatever it wants, and sometimes it moves like 500 points within minutes, right? You're gonna get cooked. It happened to me before. Like for me, I used to trade gold, right? I used to trade XAUUSD, and I didn't care about these news. I didn't care about PMIs or CPIs. I remember when CPI came out, gold moved like 6,000 pips. That's a lot. My account. My account got burned in like seconds, guys. I didn't have a stop loss. I didn't know what I was doing. I didn't have a plan. My account got burned. So the red folder news that you need to look out for is PMI. That's number one. And sorry, that's number two. And number one, guys. Okay, number one. This is okay. I mean, still red folder news, high impact news. Still be careful. But the number one, guys, the number one red folder news that you gotta look out for is the USD CPI. This is your biggest market movers. What is CPI? I have no idea. Something to do with interest rates, but they're just know that they're market movers. You don't have to know what CPI is. You don't have to know all of that. Just know USD, high impact news, CPI or PMI. Don't trade after one. Wait an hour. If you trade with that, you can get cooked. Okay. So that's it for the news. Let's go back to FX replay. I think I pretty much covered it, right? Hunt liquidity, fill imbalances, generate liquidity, and news. So I would focus on these three the most. 1, 2, and 4. Number 3 is good to know, right? Accumulation, manipulation, distribution. It's good to know as well, right? It's good to know, right? Because when you're trading, you see it in the charts as well. So you always see it, and you realize it in the back of your head. Okay. But I'm highlighting the most important ones that that we should really just focus on. Yeah. So yeah, we're gonna move on to the next video. I gotta think about what I gotta say in the next video still. But yeah, stay tuned.